Inflation is back. How long will it last? How bad will it get? And most importantly, is your retirement plan inflation proof? Hey, I'm Wes Wood, the Income Guy and founder and president of Wood Financial Group. And for nearly 20 years, I've specialized in helping hardworking Tennesseans just like you reach their retirement goals through income-based financial strategies. And if you're looking for the right solutions to achieve your own financial goals, I can help. Just reach out to me at retiretv.com or by calling 615-826-5749 during today's show or at any time. You know, odds are you've been hearing a lot about inflation, even feeling it yourself. And since winter, prices have definitely been rising. They've been rising faster than any time since 2008. And this is according to the Department of Labor. So far, Wall Street seems to have made its peace with inflation. But how long will that last? More importantly, do you have a retirement plan designed to protect you from inflation now and long into the future? And we're going to help answer those questions and more on today's show, the Inflation-Proof Retirement Plan. We're going to cover how inflation happens and what's behind the current trend, the broader risks of inflation in retirement, and how investing for income helps you give yourself the inflation-proof retirement plan. And joining me on this week's show is David Scranton. David is an investing for income specialist with over 30 years of experience, and he's also a best-selling author and a television host. But before we get to Dave, let's cover some of the inflation basics. Or the textbook definition of inflation is that there's too much demand chasing too few goods and services. It sounds like a bad thing, but it's really not. Because if you have a little bit of inflation, it's seen as a good thing because it means consumers are consuming. They're spending. In other words, they're spending their money, and that fuels demand, which is of course going to create jobs, drives growth, and generally signals a thriving economy. But the problem comes when investors start worrying about its backlash. If prices rise too high too fast, people may suddenly stop spending and throw everything into reverse. So what happens is demand drops, job growth slows, and before you know it, the economists are whispering the dreaded R word, recession. But none of that has to actually happen for the markets to be affected. Remember, the markets are forward-looking. So even if big investors are only getting a little nervous about the inflation backlash, it can still trigger a sell-off. And in fact, we saw some market volatility back in May due to these inflation fears. And since then, the markets have rebounded and achieved new record highs. But does that mean investors are done worrying? It could be, or it might depend on whether inflation gets worse, which of course is possible. And today, the driving force behind inflation is obvious. We're all cooped up. After a year of forced isolation due to COVID-19, Americans are now eager to spend. And at the same time, many businesses are still slow to fill in the inventory after this pandemic. Others are still short-staffed. And you put all that together and you have too much demand chasing too few goods and services, aka inflation. And regardless of how the current situation plays out, the more important point is inflation is how it's going to affect the economy in reality. It's also one of the most important factors in determining whether your retirement strategy succeeds or fails. And I'm going to talk about that in just a second. But right now, you can learn more by reading my timely report, 7 Risks to Your Retirement. It comes with your free retirement income kit, and you can get one of those by visiting retiretv.com or by calling me at 615-826-5749. But for now, let's welcome David Scranton. He's the founder of Sound Income Strategies and the Retirement Income Store. Hey, Dave, thanks for joining me again.
Yeah, of course, Wes. You know, it's funny because if your viewers watch financial news, they hear some analysts saying, oh, this new inflation is permanent. Others think that it's just temporary. Economists call it transitory. But it seems like the stock market is shrugging off. Wall Street is shrugging off any real concerns about inflation because the stock market, in a way, seems to be going up. And And I tend to think that they're right, that it's only temporary. What are your thoughts?
It seems like it's probably temporary, which is why, again, the markets are more forward-looking, thinking that we're not in a permanent inflationary environment. But we do need to remember that that may not be the case, because if the Federal Reserve talks about doing some things to stage off inflation, like increasing interest rates or other matters, typically that freaks out the market, especially in the short term. So even though this may look like a shorter term inflation, we need to worry about the long run, especially when it comes to the stock market and really what the Federal Reserve could possibly do.
Yeah, and when you say that, it's so true, because even if this is short term, inflation lasts throughout retirement. And I always call it,
Right.
the silent financial killer, right? Hypertension in the human body is considered the silent killer because it creeps up on you. All the damages that occur as a side effect of having high blood pressure are gradual. And the same is true with inflation. Even at a 3% inflation rate, as you know, Wes, that means that 24 years later, someone will need twice the amount of money as they did, twice the amount of income as they did the first day of retirement. So
Right.
that's at 3%. At 4%, it only takes 18 years for that retiree to require twice the amount of income as they had their first day of retirement. So that's a long-term problem.
Yeah, it is. And in the numbers you're using, 3 to 4%, we'll talk about that in the next segment coming up. But for a lot of folks that are retired, it's really closer to 5%. And so you're talking about them maybe needing 3 to 4 times as much income as they have today if they live for 30 years in retirement. And when somebody retires at 60, 62, 65, we can't just worry about those first few years. We need to worry about the long term, like 30 years in retirement. Rewind, 30 years ago today, in the 90s, what things cost. You're seeing vehicles have tripled in cost. Just general spending has gone up by more than 3% every single year. And so if we think that maybe, hey, our dollar's going to go kind of far today, well, in 20, 30 years, it may only go up a third of the way that it does. That's right.
Yeah. And, some people just bury their heads in the sand. It's too much to think about when they're projecting out 30 years. But I've heard you say
Right.
so many times, Wes, it's great to hope for the best, providing you plan for the worst.
That's right. Plan for the worst and hope for the best. A lot of times advisors out there flip those things around. So as long as we know we got enough income to cover more than our needed expenses now, and we'll talk about that in just a minute, how that can be an incredible inflation hedge. But Dave, stay with us. We're going to talk more in just a bit. And coming up after the break, I'll talk about why inflation is such a crucial factor in retirement planning. I'm Wes Wood, the Income Guy, and you're watching the Retirement Income Show.
Retirement accounts like 401ks and IRAs are great tools to save for retirement. They offer tax advantages to help keep more money in your pocket. But withdrawing money from your accounts can have a huge impact on your tax liability. Take money from the right account at the right time and you could minimize it. But taking money from the wrong account at the wrong time could result in a big tax burden. If you're not sure what you should do with your 401k in retirement, visit retiretv.com to schedule a free, no-obligation conversation with Wes Wood and Wood Financial Group.
Hey, welcome back. I'm Wes Wood, the Income Guy, and thank you for joining me today as we talk about the inflation-proof retirement plan. So far, we've looked at how the current inflation situation is and how it's affecting the markets. Now, let's talk more about the broader impacts of inflation on retirement. The immediate effects of inflation are always obvious, but the long-term effects are more subtle and even more dangerous. And that's especially true when you're retired or close to retirement. At this stage of life, inflation hits you much harder than you did when you were younger. One reason is because you can no longer count on a cost of living raise from your job to keep pace with inflation. You may think you can count on it from Social Security, from your Social Security check, but not in reality. Matter of fact, Social Security's annual cost of living adjustment, or known as COLA, often doesn't cut it because it's based on the standard consumer price index, not the consumer price index for the elderly. The consumer price index for the elderly is a separate index that measures the impact of inflation on people 65 years old and older. Sometimes you get no COLA increase at all. And even when you do, oftentimes it's wiped out by the increased cost of your Medicare Part B. A LIMRA Retirement Institute study found that even 1% inflation rate, your Social Security benefits can lose on average about $34,000 worth of spending power over a 20-year period. At 3%, inflation would swallow up more than $117,000. And historically, the average inflation rate is around 3.5%, which makes the LIMRA model even too conservative. But it's also conservative in another way. It measures the effects of inflation over just 20 years. And the reality is, like we've talked about before, you need to plan for at least 30 years of retirement income. And you need a plan that can handle the effects of inflation over all that time. And I'll talk more about that in just a second. But right now, here's your chance to learn more by reading my timely report, 7 Risks to Your Retirement. And it's free with your complimentary retirement income kit. And it's all yours by visiting retiretv.com or by calling my office directly at 615-826-5749. But now, let's welcome back income specialist David Scranton. Hey, Dave.
Wes, you know, it's funny, when you talk about Social Security, you mentioned one of the reasons why the cost of living raises that Social Security recipients receive tends to fall behind the true rate of inflation, but there are other reasons too for that, correct?
There are. I mean, if the cost of living adjustment has historically averaged with Social Security a little over 2%. And we all know inflation is closer to 3.5, maybe even 5, which means that it may not be keeping up with inflation by just half as much. It really needs to be double that amount. But the reason why, you know, perhaps the cost of living adjustment with Social Security has been so low is that it's really the way for the government to perhaps not have to give out as much of an increase every single year, so they're saving themselves money while inflation is going much, much higher than Social Security. But yeah, there's several reasons because of that.
I know you mentioned a lot of times the increased benefit you get from Social Security gets taken back by the increased cost of Medicare Part B, so the government kind of giveth with one hand and taketh back with the other, right? But that, in some ways that's understandable because the effects of inflation on health care are much greater than most of the other goods and services that a retiree would buy, correct?
That's right. You know, if you really measured inflation for retirees, health care is one of the big ones that often goes without talking about. But it is one of the areas that retirees spend money on more than pretty much every other group of life. And that type of inflation on healthcare is going up much faster than most other costs. I know for a fact that I live right across the street from a retirement facility, basically a nursing home. And just a few years ago when I moved in my house, 5 years ago, the cost for at-home stay there was around $65,000. After just 5 years, it's already up to $100,000. So you're looking at healthcare costs, which mostly comes out of the retirees' pockets, could be increasing as much as 5 to 7%, which could have a major impact on, you know, how much income they're going to need later on in life.
Yeah, and a lot of people think, well, that's okay if I need convalescent care. After I'm out of my assets, we'll just go ahead and the state will pick up the tab. But the reality of it is, I would guarantee that any of your viewers, your regular viewers that watch your show on a weekly basis, probably not one of them, when they've done their written retirement goals, has said that one of their goals is to move into a convalescent home later in life. Most people want to have that inflation hedge so that they can stay in the comfort of their home and maybe have full-time home health care as something that would be preferred over going to a convalescent facility, for example. But you know, the income model in and of itself, if done right, does take into account inflation, right?
Right. Yeah, if it's done right. because there's a lot of different types of strategies that can be used within the income model. So for somebody that's really looking to keep up with inflation, bonds probably aren't going to cut it so much because it is a fixed payment of interest for a set amount of time. May not quite be enough there to completely keep up with inflation. So a lot of times it's good to pepper in some of those other types of investments in the income model. For instance, BDCs or business development corporations have a floating rate interest. So as they're charging more interest to the companies that they're loaning money to, you're probably going to see your dividends go up. So that's a nice inflation hedge. REITs, a real estate investment trust. If you do a corporate REITs, there's going to be tenants that have leases that renew over time, and as those leases are renewing over time, odds are the cost of leases is going up, therefore the dividend checks are probably increasing to the investors. And also dividend value-based dividend stocks have a very nice inflation hedge because perhaps those dividends can increase over time. So just buying a bond may not quite cut it, which is why it's really important to have just a good mix of all these different types of managed fixed income positions, managed by an income specialist to keep up with these rising inflation costs.
Sounds like you're not talking about your grandma's income portfolio. Back in the day when you had a whole bunch of government bonds paying 7%. It's
Right.
a little different today, and that's part of the reason, too, why active management expertise is so important, more so than before, I would
Right.
think.
Yeah, it's like when my grandfather retired back in the early 80s. He sold his department store down in Moss Point, Mississippi for $100,000. Put that money into a FDIC-insured bank CD. Well, at the time, in the early 80s, interest rates at the bank were very, very high, 12%. He was getting $1,000 a month. Heck,
Wow.
if we could do that today, we would do it for all of our retirees. But now, of course, he would only get about instead of $1,000 a month, maybe $100 a month. But yeah, good point, David. And thanks again, and you stick around. Coming back after the break, we're going to talk about yet another type of inflation that can take its toll on retirees. I'm Westwood, the Income Guy, and you're watching the Retirement Income Show.
A fiduciary is someone legally obligated to act in your best interest. Doctors, lawyers, and some financial advisors are fiduciaries, but not all. When you work with Wes Wood and his team at Wood Financial Group, you are working with fiduciaries. They help clients create customized investment portfolios based off their retirement goals. If you're ready to work with a fiduciary, visit retiretv.com and schedule a free, no-obligation conversation with Wes or a Wood Financial Group advisor.
Hey, welcome back. I'm Wes Wood, the Income Guy, and thanks for tuning in to today's show, the Inflation-Proof Retirement Plan. So far, we've talked about today's inflation spike and about how some of these ways inflation have impacted retirees specifically. Now let's talk more about that now and what you need to do about it. There's another type of inflation more likely to hit retirees, and that's lifestyle inflation. There is a tendency for people to overspend their first few years of retirement, and understand that's completely understandable because when you consider most people, they want to travel and they want to achieve most of their ambitious retirement goals while they're still relatively young and still healthy. A little lifestyle inflation isn't necessarily a bad thing. You just need to prepare for it in the same ways you would in other forms of inflation. And in my experience, what that means is a strategy that accounts for all the impacts of inflation over 30 years of retirement, aka an income-based strategy. And an income specialist uses a variety of techniques to help you keep pace with inflation, even stay ahead of it. One is to help you maximize your Social Security benefits, which don't always provide a good inflation hedge on their own, as we had mentioned earlier. But in addition, many other income-based options that offer built-in inflation protection. And some of these other options that have built-in inflation protection include some annuities, some real estate investment trusts, business development corporations, and dividend-paying stocks and I-bonds. But beyond that, your inflation hedge can often be engineered through a strategic reinvestment of interest and dividends you don't need for income. In other words, investing for income provides a variety of tools and strategies to help you build an inflation-proof retirement plan. And an advisor who specializes in retirement income can help you put these tools and strategies into action. But before we get to Dave, let's talk more about how you can get your free copy of my eye-opening report, 7 Risks to Your Retirement. It comes with your free retirement income kit, and it's available by visiting retiretv.com or by calling 615-826-5749. But now, let's welcome back income specialist and the founder of the Retirement Income Store, David Scranton.
You know, it's funny, Wes, you always talk about how the first step to retirement planning is for somebody to really spell out their retirement goals and get a real clear vision of what they're going to do in retirement. But it sounds like that's most important when you're trying to decide how much this lifestyle inflation is going to affect one's retirement, right?
Yeah, that's right. It's goal setting, right? We've talked about that a lot in recent shows. And if somebody takes the time to think about what they want to be doing in retirement, a lot of times those goals are lifestyle based. Like traveling, like spending more time with their grandchildren, maybe playing more golf or having hobbies that will cost you extra money, or perhaps just eating out more. Whatever those things are that you imagine yourself doing in retirement, I bet that they're more lifestyle based. And for a lot of people, the lifestyle based goals are going to be the ones that you're going to spend more time doing in the first few years of retirement while you still have your energy and health and all. But yes, it is very important to put a number behind what those goals are going to cost, those lifestyle goals. And because if we're doing that, then we know, hey, how much income we're going to need, especially during those first few years.
You know, it's funny, Wes, part of the difficulty with thinking about inflation for most folks is planning 30 years ahead for anything is an overwhelming task. But as a pilot, you've probably heard me say before that if I'm flying an airplane at 1,000 feet, the horizon's only 38 miles away. But if I'm at 30,000 feet, the horizon's well over 200 miles away. So you're kind of like the pilot flying at 30,000 feet, whereas your clients might be at 1,000, but you can see a lot further and help let them know if there's any obstacles ahead.
Right, Dave, and that's a good analogy. I'm not a pilot. Probably a lot of my clients aren't. But think about it like as a chess grandmaster. Chess grandmaster isn't going to think about that for just one move ahead. They've already thought about 5, 6, 7, 8 moves ahead. As a matter of fact, the more moves ahead that they've already imagined that they're going to do and they put into action, the more likelihood they're going to win that game of chess. But a lot of people, unfortunately, don't play it that way in retirement. They think more of the short-sighted goals, and they don't think about 25, 30 years out there, what things are going to cost and what kind of income they're going to need. They only think about that next step. So whether you're a pilot, 30,000 feet up in the air, able to see way out and plan for the worst situation, or a chess grandmaster as you're planning for those 5, 6, 7 moves ahead, you're much better off taking that approach than just thinking about just one move ahead.
Well, we said that part of the reason active management is so important is because this isn't your grandmother's income portfolio or your grandfather's in your case where you're in a CD earning 12%. You're in other things that could provide inflation hedge that may have a little bit more risk that need to be managed. But also, the active management process is important based upon, I guess, what people's specific goals are and how those specific goals are affected by inflation, right?
Oh yeah, absolutely. I mean, I've talked to many folks that their income that they want to have in retirement, even their lifestyle goals, factoring it in, they don't have to take on very much risk at all. And they can go into the more conservative income generating, and they love having that peace of mind and that security that they get with that type of income model. But then I do have some people that, hey, we are thinking way ahead, that they're going to need more income. And for those folks that have okay risk tolerance, maybe we need to pepper in some of those investments that are going to give us a hedge to give us more income later on in life to make sure that we're going to have plenty of money there waiting on us so we're not depleting principal later on when we're probably going to need it the very most.
You know, Wes, that's what I love about you the most. It's not a one-size-fits-all thing like a lot of advisors who have 3 portfolios and they size a prospect up and they put them in one. You're customizing portfolios for your clients' goals. And I just hope and pray they appreciate that, because that's what's really going to help them the most throughout their retirement.
Yeah, the cookie cutter approaches that many advisors use can maybe work for some of those growth years, the younger years, but then you need to make a shift, need to make a change to more customized portfolios that aren't just the cookie cutter strategies that may not work in retirement. Really needs to be focused more on individual positions that are well managed in the fixed income world, working with an income specialist. But David, thank you for joining me again today on today's show. Hey, I'm Wes Wood, the Income Guy. Thank you for watching. And if you have any questions about anything we've covered on today's show, please reach out to me at retiretv.com or by calling 615-826-5749. Hey, we'll see you again next week. Hi, I'm Wes Wood, founder of Wood Financial Group. There are hundreds of different ways you can claim your Social Security benefits, but the difference between the best way versus the second best way could be the difference in tens of thousands of dollars over your lifetime. You don't want to miss out on an income stream that could help fund your retirement dreams. Go to retiretv.com to claim your custom Social Security analysis from Wood Financial Group. We can help maximize your Social Security benefits in retirement.
Retirement accounts like 401ks and IRAs are great tools to save for retirement. They offer tax advantages to help keep more money in your pocket. But withdrawing money from your accounts can have a huge impact on your tax liability. Take money from the right account at the right time and you could minimize it. But taking money from the wrong account at the wrong time could result in a big tax burden. If you're not sure what you should do with your 401k in retirement, visit retiretv.com to schedule a free, no-obligation conversation with Wes Wood and Wood Financial Group.